$2.9 billion. Circle just overtook the largest tokenized fund in the world. 3 questions. Why did Circle just beat BlackRock at their own game? What was the one design choice that did it? And why does it matter for the next issuer? Here's how it happened. 2 years ago, the entire tokenized Treasury market was worth less than $1 billion. Today, it is over $15 billion. 5 funds control 68% of it. This is the fastest growing institutional segment in crypto, and the playbook that wins this category will be the playbook for tokenizing everything else. Here's the thesis. BlackRock built a fund. Circle built collateral. The market wanted collateral. The rest of this episode is how that happened, what it cost BlackRock, and what it means for the next issuer. Quick teardown of BUIDL first. The legal wrapper is a Delaware fund registered under Reg D 506C and Section 3C7. Boring. Same wrapper any institutional money market fund uses. The asset layer is short-term treasuries, repurchase agreements, and cash, custodied at BNY Mellon. The token itself is a permissioned ERC-20, issued and operated by Securitize. Yield is calculated daily and distributed as new tokens directly to holder addresses. Holders are restricted to qualified purchasers with a $5 million minimum. Redemption clears 2 ways: a same-day USD wire or an intraday swap to USDC through Circle. BUIDL went live on Ethereum, then expanded to 8 more chains, including Solana, Avalanche, Aptos, Arbitrum, Optimism, Polygon, and BNB Chain. Today, 68% of BUIDL's assets sit on chains other than Ethereum. By every conventional measure, this should have been the winning product. BlackRock is the largest asset manager in the world, $11.6 trillion under management. The brand alone clears compliance reviews. Securitize had been building permissioned token infrastructure since 2017. BNY Mellon is one of the most trusted custodians on Earth. The Circle USDC integration was operational, not pilot. By any traditional reading, this is the team that wins the category. For 18 months they did. Then they didn't. Circle launched USYC, a tokenized treasury product with a different shape. On paper, it looks similar. Holds short-term treasuries, pays a market yield, issued by a regulated entity. The structural difference is in one line of contract logic. BUIDL distributes yield. Every day, Securitize mints new tokens to your address representing your accrued interest. You hold 100 BUIDL today, you might hold 100.01 tomorrow. 2 separate balances, 2 separate movements. USYC accumulates yield. The token balance stays the same. The price per token grows. Your accrued interest is already inside the token you already hold. That sounds cosmetic. It isn't. Automated collateral systems on derivatives venues track token balances, not token prices. Post BUIDL as collateral, and your yield arrives as a separate token transfer that breaks the collateral relationship. Post USYC as collateral, and the position appreciates automatically. The collateral system never has to do anything. Add 3 more facts. USYC has a $100,000 minimum. BUIDL has a $5 million minimum. USYC accepts non-US qualified investors. BUIDL is US only. USYC was integrated into Binance's off-exchange collateral system in July 2025. BUIDL got the same integration in November 2025, 4 months later. Distribution plus collateralization beat brand. By March 2026, USYC was the largest tokenized treasury fund. Today, it sits at $2.9 billion. BUIDL sits at $2.58 billion. In the 30 days when the lead changed, USYC grew 11%. BUIDL contracted just under 3%. Step back. BUIDL and USYC look like the same product because they hold the same assets. They aren't. BUIDL is a regulated fund with a stablecoin gateway bolted on. The fund is the product. The on-chain token is a representation of fund shares. The wrapper drives every design decision. USYC is a yield-bearing stablecoin with a fund wrapper bolted on. The token is the product. The fund exists to make the yield real, and the wrapper exists to make it legal. The token shape drives every design decision. Institutional buyers in 2026 are not buying a fund. They are buying productive collateral. Whoever optimizes for that wins. BlackRock built a fund. Circle built collateral.
Where the top 5 sit as of late April 2026. Circle USYC at $2.9 billion. BlackRock BUIDL at $2.58 billion. Centrifuge, JTRSY, Franklin Templeton, Benji at roughly $900 million. And Ondo, USDY, round out the top 5. Fidelity's tokenized fund sits around $160 million. The category is no longer a duopoly. By the end of 2026, expect at least 4 more institutional issuers in this segment. Speaking of new entrants, on December 15, 2025, JPMorgan launched MONY. my on-chain net yield fund. Same wrapper as BUIDL, Reg D 506C, public Ethereum. Tokenized on Kinexys, JPMorgan's own platform, not Securitize. Distributed through Morgan Money, JPMorgan's existing institutional cash desk. $1 million minimum, half of BUIDL. Seeded with $100 million of JPMorgan's own balance sheet. JPMorgan is the largest globally systemic bank to issue a tokenized money market fund on a public chain. They picked the wrapper that just lost the category lead. Their bet? Vertical integration across tokenization, custody, and distribution beats horizontal stack composition. We will know in 12 months if that bet held. Back to BUIDL and USYC. Every tokenized issuance has 3 layers: legal wrapper, asset, cash. The 2026 lesson is that the cash layer is the product, and the wrapper and the asset are commodity. Wrapper: Reg D, Cayman, BVI, Luxembourg, ICAV. Each pick decides your buyer pool. None of them changes the product quality. BUIDL chose Reg D for U.S. institutional credibility. USYC chose Cayman for global reach. The Cayman wrapper outperformed the Reg D wrapper by AUM. Asset: Treasuries, repos, cash. Identical across the top 5. This is not where the contest happens. Cash. This is the entire contest. Whether yield accrues or distributes. Which stablecoin clears redemption. Which off-exchange collateral systems your token plugs into. Whether atomic settlement is real or marketing. These are software decisions made by issuance teams, not finance decisions made by treasurers. The category leader is whoever ships them fastest. BUIDL versus USYC. By the numbers most institutional buyers actually weigh. Brand. BlackRock versus Circle. BlackRock wins. Wrapper. Reg D 506C versus Cayman. USYC wins on distribution reach. Minimum. 5 million versus 100,000. USYC wins on funnel size. Geographic eligibility. US qualified only versus global ex-US qualified. USYC wins on addressable market. Yield mechanic. Distributed versus accumulating. USYC wins on collateral compatibility. Redemption rail. USDC same day versus USDC atomic. USYC wins on speed. Off-exchange collateral integration on Binance. November 2025 versus July 2025. USYC wins by 4 months. AUM, late April 2026. 2.58 billion versus 2.9 billion. USYC wins. 8 categories that matter. BlackRock wins one of them. If you are sitting at a treasury desk, an asset manager, or a fund admin team thinking about tokenizing your own product, here are the 3 decisions BUIDL and USYC force you to make. 1. Pick the wrapper for distribution, not for prestige. The Reg D 506C wrapper is clean for U.S. institutional capital. It locks out the rest of the world. The next category leader is structured offshore for a reason. If your buyer pool is global, your wrapper has to be too. 2. Design the cash layer first. Decide whether yield accrues or distributes. Decide which stablecoin clears your redemption rail. Decide which off-exchange collateral systems your token plugs into on day 1. These 3 decisions determine product market fit. The wrapper and the asset are what you build around them. 3. Multi-chain from day 1. BUIDL launched on Ethereum and waited 18 months to expand. Today, 68% of their AUM sits off Ethereum. Whoever issues next does not have 18 months. The category leader meets institutional buyers where they already hold collateral, which by 2026 is not a single chain. BlackRock did not lose because they were wrong. They lost because they were building a fund. Circle was building collateral. The market wanted collateral. $2 billion and 12 months later, that's the whole story.